My name is Michael Gaia, publisher of the Lead Lag Report. Joining me for the hour is Arlan Suderman. Arlan, for those who are not familiar with your background, introduce yourself. Who are you? How'd you get involved, interested in markets, and why commodities in particular?
I grew up in a small Kansas farm and had a great passion for helping agriculture and just kind of the foundation of our culture and where we come from, how we eat in this country, and we do it better than any other country of the world. And so as I got out of college, I pursued opportunities to do that and started working with farmers and helping educate them on how to grow crops. And they said, "Now we need help with understanding the markets and how they work." And so I spent a lot of time studying that and just became a student of the markets at that point, and noticed that there was a lot of interaction between the commodities and the financial markets, and started studying those connections between the commodities and the financial markets, the currency markets, and the correlations between them. That's really where I built my niche, which led to an opportunity then to be an analyst for the North America's largest ag publishing company, which was Farm Progress Companies, being their analyst, which then led me to working with a coworker to get about 65% market share for farmfutures.com, which was for high-end farmers and helping them. That started opening doors in other commodities and working with advisory services. And then finally, StoneX gave me a call and said, "We'd like you to head up our research team for all commodities, be chief economist for overall commodities." And so StoneX has a broad-based interest in trading commodities around the world. We are involved, large lumber traders, with the largest coffee traders in the world, probably trading just about anything that can be traded in the world and just about every market of the world. And we have boots on the ground around the world. And so my position really became then one of studying the domestic and global economy and seeing how that's going to affect demand and trade flows of commodities going around the world. It's been a fascinating journey overall. I love being a student of the commodities and of the economy, and just seeing what it can teach me and then communicating that to others in a way that hopefully helps them bring some clarity to some of the patterns. One of the keys also that I've spent a lot of time studying over the years has been the flow of money into these markets, which dramatically increased starting about 20, 25 years ago and has continued to increase. And then the advent of algo computer trading and how that has impacted and changed the dynamics of how commodities are traded in the world, and then help communicate that to our customers to try to make sense of how the market dynamics are working.
Do you find that commodities as an asset class are more efficient, just from like an efficient market hypothesis, that it's tends to react faster or probably be more accurate than stock prices at any moment in time?
Well, the commodity and stock price trading is very different from the standpoint. And I think we see a lot of the influence spill over into commodities now. There's a lot of Wall Street money, billions of dollars of Wall Street money coming into the commodities to trade them. Because on Wall Street, once you trade a story, you figure, okay, it's priced into the market. With commodities, though, you have to have a buyer and seller with every transaction. And just because you've traded a fundamental story in doesn't mean that that story has gone away. And a good example of that would be with the war in Ukraine. We saw a tremendous war premium put into the commodity markets a year ago, this being the 1-year anniversary of Russia's invasion in Ukraine. And then over the following year, after we traded that war premium started to go out because the money flow started focusing on Federal Reserve policy and expectations that the Fed would drive us into a recession, and therefore that would decrease demand for commodities. And we basically removed all of the war premium for most of the commodities that were affected. The story didn't go away. The supply and demand fundamentals didn't change, but the money moved on to other things. But it's still a factor. And so that, for many people who are both producers of commodities as well as end users of commodities, that didn't make sense to them. And part of my role then was to explain this is the function of it. The cash market continues to do that. So there's a little bit of a disconnect, and at times a significant disconnect between the cash market for commodities and what the futures market is trading. I give a lot of presentations to groups, and about 9 months before the war started in Ukraine, I started including a slide in my presentations of 3 potential black swan events that could dramatically impact the commodity markets going forward. Now, black swan events, by definition, are impossible to predict, but as an economist, I'm going to try to predict it anyway. One was if we'd get a more lethal form of a variant of COVID. Now, that's rare. It happened in the 1918 Spanish flu, but it would be a potential black swan event. Number 2 was Russia invading Ukraine. And I got a lot of laughter when I said that 9 months before the invasion. Arlan, that'll never happen. Number 3 was China making a move to take over Taiwan. That hasn't happened yet. I got a lot of laughter with that one as well, but we're a lot closer to that today than what we were at that point. But even as we came close, you mentioned in January of last year before the invasion, even into early February of last year, as we would talk to our contacts, and we have customers in Ukraine and we have contacts in Russia, and both are saying it's not going to happen. And I felt strongly it would. In fact, I even published in my commentary, I thought it would happen on February 24th. I guess, you get fortunate at times, but Russia in its culture really, puts a lot of importance on anniversaries. And this is a big day in Russia's history of events happening. And I thought it would be on this day. And that's the day it ended up happening. But I think a lot of people just thought, oh, life will continue as it has been. It won't happen. And I think they have the same approach regarding China and Taiwan. Much different situation regarding commodities, though, with Russia invading Ukraine. The 2 countries really make up the breadbasket of the world, supplying food and fertilizer to many parts of the world. China, on the other hand, is a major importer of those commodities, other than fertilizer, which they export, but is food-based commodities and energy-based commodities. So very different potential implications for the commodity markets. But I think the market simply didn't think it would happen. And even though we talked about it a lot, kind of the whisper was, oh, it's not going to happen. There will be a settlement and we'll move on. Well, I think there has to be, the markets are very headline driven right now. Some of that's because of algo, some of it's just behavior of the people involved in the market, but very headline driven. And that's across the board, the different sectors. And so it has to be a headline that really raises fears once again. And right now the focus is mostly on the economic side and recession and stuff. So it has to be a headline that would threaten, raise concerns about commodity supplies. That could take a number of different twists to it. I do think that we're moving toward more escalation of the war because Russia is determined. It has said there's no reason for a major nuclear power to lose a significant military conflict. They keep on touting their nuclear prowess and abilities. China has a vested interest in making sure Russia does not lose the war. And China is concerned that the longer this goes on, the greater the risk that Russia could lose it. So China has a vested interest in making sure that doesn't happen, that Russia doesn't lose. Meanwhile, Europe and the West, the United States, NATO, have a vested interest in making sure Russia does lose the war. And both sides are really digging in. We did have China make a peace proposal. I think it's largely a non-starter with Ukraine. That was over the past 24 hours. I think we're heading toward a greater conflict. So how could that affect the commodities? Right now, Ukraine is able to export some over land, some through the 3 accepted ports near Odessa. That initiative will probably be extended because Russia has incentive to cooperate with the UN and with Turkey, who really want that extended. But they're slow walking inspection, so they're limiting it. But they also know that Ukraine's ability to produce commodities is going down. Each year this war drags on, they'll have less production to be able to produce as their infrastructure gets destroyed. Russia is a big producer, so what about it? The more this war intensifies, the more that risk that something could happen to block Russia being able to export as well. That could take several different forms, whether it's the U.S. in the Black Sea doing a blockade, or stronger sanctions, or a broader military attack inside Russia. I'm speculating on what it could be, but the longer it goes, the more it intensifies, that risk goes up. One of the other things, if you talk to farmers inside of Ukraine, say, what do you most fear? A lot of them say, what we most fear is an accident at the nuclear plant near Mykolaiv. That's Europe's largest nuclear plant. There have been a lot of close calls with missiles landing right around it. And what they fear is Chernobyl Part 2. In other words, a much bigger incident than what we had in Chernobyl in 1986, which would deem a large area of farm ground unfarmable for decades to come. That's what farmers in that area say that they fear. That certainly would draw a lot more attention, because that would say after the war is over, we still can't produce in a major area. And it's not just in that area of Ukraine, but downwind into Russia as well. Back in 1992, I had the opportunity to help host Boris Yeltsin, who was president of Russia at the time, on a Kansas farm. It was wheat harvest time, and he addressed the farmers at the time, and he said, "You are the breadbasket of the world. The wheat that you grow here comes from my country." And that's true. It was brought over by immigrants in the 1870s. And he said, your yields are 3 times what ours are. But we are investing in our technology, and their day will come when we will be the breadbasket of the world and not you. And that has certainly became true. They have done that. But if you remove that ability to produce food for the world, that's when the market will get excited once again.
Which is interesting. This actually all goes back to my initial question around efficiency of information and commodities, right? It sounds to me like, and Jake, you'd probably agree, there's an underappreciation of these tail risks that price currently is not reflecting.
Yeah, that's exactly right. Because prior to the Russian invasion of Ukraine, the world was becoming very comfortable with just-in-time supplies of commodities. If you would track corn and wheat supplies, which are basic food commodities needed to feed people directly or to produce the livestock for the meat that they consume as well. If you would track global supplies of corn and wheat in terms of days of supply, they were trending lower for the last 50 years. And that trend continues to this day because the world is becoming comfortable with our transportation system. If you needed it somewhere, you could get it relatively quickly. We could move it around, and we had a pretty efficient transportation system. Now, suddenly, that's all changed. Who you do business with is not who has the most efficient way to get it to you. It's, are you a friend or foe of Russia? And more so, are you a friend or foe of China? So what that does is that changes who trades with who. It lengthens freight lines. That ties up ocean liners, bulk ships in longer trips, so they can transport less volume in a year's time, increases freight costs. And so it's got countries saying, I'm no longer comfortable just-in-time supplies. We need to be building up our inventories and kind of hoarding some supplies and having some larger reserves on hand. That came at a time when we had 3 years, which is very unusual, of La Nina. La Nina tends to be adverse to production in key production areas of the world, give you drought in key production areas of the world. Yeah, no, they're really not stocked up. They used to have massive reserves, a year's supply on hand. They no longer have that. Now, the reserves are closely held secret. But if you look at what's happening and what the signs are, for a long time, they were supplementing the demand, which exceeded what they were producing each year. They were supplementing that by drawing from the reserves, auctioning it off to users of the corn. And they'd be auctioning off supplies from their reserves that were 5 years old, 6 years old, 7 years old. Well, now they're down to auctioning off supplies that were imported over the past year. So that tells us their reserves are getting very low, because you always want to auction off the oldest so you keep rotating supplies to keep the quality there. So their supplies are rather tight. And that's true for soybeans as well. For wheat, the reserves seem to be bigger, for rice as well. But those reserves are getting tight enough now, they're no longer comfortable. And they just indicated recently that they're going to auction off about 25 million metric tons less rice this year than they did last year. And a lot of that rice that was being auctioned off that they considered to be surplus was going into the feed stream, replacing corn. And they're saying, no, we got to hold on to what we've got now to make sure we have enough food supply. So that means that we expect that China is going to need to import more corn to displace where they were using rice as instead in some of their feed rations. So, you think, okay, that's positive for the United States, and in a way it is, but they have also finally come to a phytosanitary agreement with Brazil so that Brazil can be a major supplier. And Brazil is a BRIC nation within the coalition that they have strengthened here over the last 8 months or so. And so their first choice is going to be Brazil. Just with currency exchange rates, Brazil corn is going to be cheaper anyway. So they're going to be buying much of their corn from Brazil, and Brazil is dramatically increasing production and expanding the area they produce. Brazil is the one country in the world that has land that can be converted without touching the rainforest. They have millions and millions of acres of brush land that can be converted to cropland and increase production, and they're in the process of doing that. The only thing holding them back is growth of their infrastructure and development, and they're working on that. So I do think China is going to be importing more. I do think that's going to exceed what the current expectations are, government expectations. But I do think that Brazil's going to get the larger portion of that. That will help keep global supplies tight, but not necessarily be felt as directly in the U.S. markets.
You had earlier mentioned the Black Sea, and maybe just explain for the audience, why does the Black Sea matter, and how is that sort of a complicating factor for the U.S., Russia, and Ukraine?
Well, the Black Sea, Russia in particular, is a major producer of crude oil. And so that goes to the world energy supply. Russia and its puppet countries around it are major exporters of fertilizer necessary for producing food in the world. Russia, Ukraine, other countries around the Black Sea, as I said, are really the breadbasket of the world now because they're major exporters of food-based commodities like wheat, one of the foundational food commodities that is consumed in the world. And so trade through the Black Sea is essential in order to keep the world eating and consuming and have enough food. And really the countries most at risk are those lower income countries, really stretching from North Africa east all the way east to Pakistan. That's the area most directly impacted that relies most heavily on food coming through that Black Sea region. And that's also the area where we had a lot of changes in social unrest during the Arab Spring. And so that risks political unrest in that area as well, which can have a major impact on world geopolitics as well.
So Jake had sent me your note, and he highlighted a particular sentence, which I want to myself hear more about from your note. This morning, China released 2 key hit pieces via its state media this week, seemingly focused on preparing its people for a more direct conflict with the U.S. What is that? What were those hit pieces, and what's happening in terms of China's communication in terms of preparing citizens?
Yeah, we've got a couple offices in China, one in Shanghai and one in Beijing. And one of my employees who works out of the Shanghai office is native to China. And then I have Chinese employees here in the States as well. And so they help keep me abreast of what's happening each morning. And it started on Tuesday of this week when they brought to my attention that the state-run media in China had published a 4,000-word article that really simply attacked the United States as being, my words, the evil empire over its 200 plus year history, and all of the sins of the United States in dominating and controlling the world and causing all kinds of atrocities around the world over the last 200 some years of its existence. That followed that then on Wednesday by publishing the peace document that President Xi Jinping had first released last April, but it published it on Wednesday. And that's kind of Xi Jinping's plan for how to achieve peace in the world. But if you read through it, it's all about how the United States is really the problem. And so you have to control the United States to have peace in the world. So my Chinese employees saw that as really China kind of preparing its citizenry for a more direct conflict with the United States. Simultaneously, this week, its head of its foreign ministry traveled to several key European countries, then went to Ukraine the day after President Biden made his surprise visit there, and followed that with a trip to Moscow, trying to propose a peace plan. But basically, China has taken a more aggressive approach against the United States. In its past history, prior to Xi Jinping, its preference was to find a way to peacefully grow. It has stated it wants to become the world's number one economy and number one military, and it sees those two as inseparable. One cannot happen without the other. But it always tried to do so very peacefully, saying, hey, we want to be friends with you, while behind the scenes it was doing things to aggressively move to be number one. This is the first time it's become publicly aggressive in its stance toward the United States, and almost preparing its people for direct conflict, whether that be in the Russia-Ukraine war or whether it be in a conflict with over Taiwan.
And that's different than a more classic propaganda from China. Like, this is a much more stepped up tone.
Yeah, absolutely. In the past, it would always have a peaceful tone while doing things in the background. And, the old saying, don't listen to what China says, watch what they do. Well, now what they're saying is becoming aggressive along with what they're doing. And we need to go back to the 20th Congress of the Communist Party, which was held in October, when Xi Jinping solidified his power for as long as he wants it, although people within China think he'll retire after this current 5-year term. But he also solidified his Politburo, which is the 7-member leadership team at the very top of the Communist Party, of which he's one of those 7. He removed anybody who had questioned him or had any doubts or had publicly made any statements questioning his policies. He installed onto that 7-member committee the general who had been in charge of China's East Theater, that had put the blockade around Taiwan in response to Nancy Pelosi visiting Taiwan in August. He had changed the constitution of China to not only permit the takeover of Taiwan, but as I read it, to almost mandate the takeover of Taiwan. Now, they want to do it peacefully. That's their goal, because Taiwan has critical infrastructure in its chip manufacturing of the highest class of chips in the world. 95% of them are produced in Taiwan. It wants to maintain that infrastructure. It wants to do it peacefully, just like it did Hong Kong. But with an island nation, it's a little bit more challenging. And so it wants to do that. And as long as the United States stays out, it thinks it can do that using the long-run strategy. But if the United States steps up its insertion of military equipment into Taiwan, that'll probably move its calendar forward, because it doesn't want to do what Russia did and give the opportunity for the West to militarize Ukraine or do that same thing to Taiwan. It wants to be able to act before the West can really militarize Taiwan to a great enough effect to be able to defend itself. China knows that much of our military equipment is tied up in East Europe right now. So that works to its advantage regarding Taiwan. It was not happy, though, to learn this week, because the administration had been trying to keep it secret, that they do plan on adding about 200 to 300 military members to Taiwan. They've been running about 30 people there, special ops type of people in Taiwan to do training of Taiwan's military to how to defend themselves. Now we're stepping that up to between 200 and 300 people. So that does not make China happy at all, and may help escalate the timetable at which they do this. In my sense, is that they would like to do a blockade. For example, Taiwan law only requires them to maintain about 9 days worth of natural gas reserves for operating their factories. So therefore, it wouldn't take very long of a blockade to start shutting down factory production in Taiwan and start negatively impacting the economy in Taiwan. Obviously, you'd have to hold longer, though, for people to start going hungry or something like that, to where they would give in and say, okay. The big key question, if they did a blockade, would be, will the United States intervene? Will we intervene, or will we just show force but not use force? So that's a little bit of their gamble. We recently have increased our military presence in the Philippines on the side toward Taiwan. And so that doesn't make China very happy. We've been trying to enforce the international waters in the South China Sea that China has been trying to claim. That's part of the conflict. So we've been confronting China in that area. But will we, if they repeat the blockade that they did for a matter of days in August, will we actually violate that? Will we attack their ships, so to speak, in order to break that blockade? That is the big gamble that Xi Jinping is asking himself and taking a risk on. And neither side wants direct military conflict with each other. But as you recall, it was about 4 weeks ago, a 4-star general here in the United States made the prediction that we would be at war with China by 2025 over Taiwan. So we seem to be moving in that direction. Well, one of the problems is the Fed was too slow to act. I commented in June, I believe it was, of 2021. I posted on Twitter that I was really concerned if the Fed didn't start acting pretty quickly, that inflation was going to get out of hand and become more difficult for it to tame again. And, as anybody who posts on Twitter, you're going to take some hits. So I immediately got a hit from somebody who said, "Oh, come on, Arlan, when has inflation ever been a problem in this country?" And before I responded, I looked at his profile, and he was a gentleman probably in his mid-30s. And I thought, okay, he never lived through the late 70s and early 80s. I remember very clearly being thrilled to be able to get my first home mortgage at 10% interest rate, because they were on the way down from closer to 20% 10 years earlier. So it's all in perspective. And that was my concern, that the Fed kept talking transitory inflation, and there were certainly factors of transitory inflation related to supply chains, et cetera, that were component of it. But there's a lot more deeply seated elements of inflation as well. And it goes back to the stimulus that we put into our economy. And some of that was fiscal, and some of that is monetary stimulus. We're still doing fiscal stimulus. Monetary stimulus, the Fed is trying to pull back on. Why do they give stimulus? Well, during COVID, we did stimulus to try to keep our economy going. How do you do that in a consumer-based economy? You give consumers money that you hope that they will spend to keep demand going, to keep production going, et cetera. And that's exactly what happened. But they overstimulated. And if you look at the data prior to COVID, prior to the pandemic, we were largely a service-oriented economy. We all went home when COVID hit. We were told to stay home if we could, so we went home. So demand for everything dropped, especially services. Then we started getting our stimulus checks, and we rediscovered Amazon and Walmart.com. And we learned how fun it was to sit at home and spend money and have a truck pull up outside of our house and deliver all kinds of consumer goods. And so if you track the durable goods orders and adjust it for inflation, we saw a huge surge in durable goods orders beyond what the level was of our supply lines to supply, let alone when those supply lines were hampered by the pandemic. So that's transitory inflation. But even as we have now fixed and adapted to that, we still have trillions of dollars of stimulus in our economy so that we still have a level of spending that exceeds our ability to supply, which creates inflation beyond just the commodity side of it. The commodity side is really pulled back, but now we're in the core of it. And where we really see this played out is the 4.5 million people who retired early because the stock market did so well. And one of the reasons it did so well is we can track with the data how much of the stimulus money went right into the markets to give us a nice run and for people's 401ks to expand. So we lost 4.5 million employees. We had other people who just still wanted to stay home and collect their unemployment check benefits or whatever. And there's various other reasons we shrank the pool of employees. So wage inflation became the big problem at that point. We've never been able to tame inflation without taking interest rates above the level of inflation. And we can't take inflation down to the 2% mandated level without taking wage inflation down. It simply won't happen. And the Fed seems to get that now. They seem to understand that now. The markets don't believe that they have the courage to hold rates high enough for long enough in order to experience the pain to our economy of bringing the number of employees in balance with the number of positions available. But that's the Fed's only choice based on their mandate. They don't have any policy tools to increase the availability of workers. All they can do is reduce the demand for workers, and they can only do that by slowing down the economy. But that's been extremely hard for them to do because A, there was so much stimulus in the economy, and B, Congress is still adding stimulus to the economy. So that's the conundrum that we find ourselves in now. The other key component that goes into this is velocity of money. And velocity of money, of course, is the number of times a dollar circulates in the economy. And that peaked out 20 years ago, right around 11 or 12. And then in the Great Recession, it started to fall, and largely because of the aging baby boomer generation who started becoming worried about the future. We saw a really sharp decline in velocity of money to where by the time we got to the pandemic, it dropped to 1, virtually a record low. So we were not recirculating those dollars. And so what would happen to inflation if suddenly the consumer started becoming confident enough to start circulating that money and spending it? And that ties into your question. What can the Fed do? Because we're looking at consumer sentiment numbers. We got updated numbers this morning that came in better than expected, and consumer sentiments has started to tick higher because gasoline prices at the pump have fallen and are starting to adjust to these inflation numbers. What if that consumer sentiment comes up and people start becoming more comfortable spending that money? We could just really reignite this inflation. And so the Fed is trying to pull that money out. It's doing so at a rate of about $1.14 trillion per year. And it's going to take some years to get it out. The problem is the economy has become addicted to that money being in the system. That's part of our cash flow in our economy. And so will they be able to do that? But I mentioned the $1.14 trillion it's pulling out. It did so by buying our government's debt certificates. It was buying about 60% of our government's debt certificates during the pandemic, and it now owns about 25% of our nation's debt. So if you consider that Congress is increasing spending and adding to the supply of debt certificates at about $1.5 trillion per year, that leaves us with about $2.5 trillion of debt certificates that we need to find new buyers for each year to keep interest rates from going higher, because the only way to get those new buyers is to raise yields. so that people are attracted to that market. That's a more natural way of raising interest rates other than the Fed simply pushing them up, which only can do with the short-term rates. So the Fed is probably going to come into a situation where it wants to withdraw that stimulus, but we have a shortage of buyers of those debt certificates as it starts to do so, that it's probably going to have to go back into quantitative easing once again just to keep interest rates from getting too high. That would really put the brakes on to a greater extent than what it can afford to happen on the economy, sending us into a much deeper recession. We have never been in this situation before. In fact, if you read some of the comments of the former president of the Kansas City Federal Reserve prior to Esther George, who just retired, was Ken Honig. He said, I'm not sure how they're going to do it because this is unprecedented territory. I'm really not sure how the Fed's going to give us a soft landing. I think I quoted him basically right on what he said there. It's a challenge on whether they're going to be able to do this. And the market wants to be an optimist. And I don't want to be a doomsdayer by any means. That's not my intention. But we also have to face reality of what needs to happen in our economy because it's going to affect all of the markets, be it commodities, the equities, the currency markets. They're all going to be affected by this.
Doesn't what really need to happen is not to sound overly dramatic, but effectively a housing crash? I mean, if you want to increase the number of people looking for work, collapse their home values. If you want to reduce credit creation, collapse their home values. If you want to get people to be less confident to prevent the velocity of money from picking up, crash their home values. I mean, it seems to me that that's sort of the only way to resolve all this.
Well, and we were on a path toward that. We were starting to see that happen, and then consumer sentiment started to improve. And like this morning, new home sales came in way over expectations. And so, again, there's enough money in the system that people adjust. And I told you my first mortgage, I was thrilled to get a 10% mortgage. People adjust. And so if you start feeling comfortable, okay, this is the new world we're in, and I'm not as worried about the future anymore. I'll just adjust my budget and I'll pay that higher interest rate. And home values have dipped now, so maybe that's the time to get in. Perception is reality to the consumer. And, it was about a year ago, my son and his wife are looking to buy their first home. And he said, Dad, interest rates are up about 5.25% right. That's probably about as high as they're going to get, right? Should I just wait till they come back down before I buy my new home? I said, well, son, let me tell you a story. And started talking about what interest rates were the last time we went through this cycle. And I said, are they going to go there? I don't know. I can't tell you that. I just want you to know they can go a lot higher. Well, he took a dip in the market and I think got about a 4.8% rate or so, and he's got his home and he's happy he did so. But perception's reality, and consumer perception is going to be big going forward.
You'd mentioned that you also deal with lumber at StoneX, and my right eye is lumber because of the link to housing. Lumber had a pretty strong start to the year and then went around trip. I'm curious if there's anything that you yourself have observed when it comes to the lumber market, if it's maybe warning that you're going to have a real slowdown in housing construction because of the lagged effect of permits and then obviously framing and ordering of lumber.
We've seen that. And for a while, it was to take advantage of the home equity loans to do remodeling. We saw a big surge in that, and that accounted for some of the lumber demand as well. And there were other factors involved, including rail logistics, trade negotiations, fires, some lumber areas and stuff like that. But basically, the lumber market has reflected that slowdown in home buying, new home construction particularly. That was a combination of sluggish demand because of the economy moving toward a slowdown and a labor shortage. We certainly had a big shortage of labor in the construction industry that also slowed down. We still have a shortage of homes, though, in this country. That really goes back 15, 20 years in development, but we still have a shortage of single family constructed homes. And eventually we're going to have to make that up. but it's going to be down to the economy on the timing of when that happens. We've got a lot of the younger generation who has not gotten into their own home yet, who wants to be into their own home. And so that demand is there. It's just been put off for a while.
For those in the audience, Arlan, that are bullish on commodities as a theme, as an asset class, where are the mispricings greatest? I'm curious, just from your perspective, when you look across the entire commodity space, whether it's oil and gas or agriculture, is there some part of the commodity space which is more mispriced than others?
I think the area that I see the most potential for inflation would be in the energy commodities. With China now finally opening up and COVID moving through that population very quickly and developing herd immunity, their economy is going to take a while to come back. But one thing that they are doing is they are traveling. And so we anticipate that just the increase in air travel is going to add consumption of about 800,000 to 1 million barrels per day of crude oil. So that's going to be significant. Other economic growth between China and the rest of the world, we anticipate overall growth in global demand for crude oil being up about 2.2 million barrels per day this year, developing. But if you look at OPEC's ability to produce, it's having trouble meeting its current quotas. So it's having trouble being able to increase. There's a couple exceptions where they could increase, but overall it's going to be a challenge. Russia, they're talking about decreasing output by 500,000 barrels per day. And that could end up even being a little bit more because of some of the sanctions that are being applied to it. The shale oil fields in the United States, or the growth in production we've seen there over the last couple of years has largely been from wells that were started but not completed before the pandemic, that we have now gone in and completed those wells. So we're at the point, if we're going to further expand production, it needs to be through new investment. Well, in this realm of ESG investments, there's not a lot of money available for expanding, putting down new rigs, let alone finding the crews to work those rigs. So that's going to be difficult to get that expanded production from the shale oil fields. So we could very easily find ourselves, if we do continue to see a resilient economy, and if China is able to come back this year, those are still somewhat debatable, but we could see energy prices see the greatest threat. The Ukraine war could also play into that as well, with Russia being a major exporter. Then behind that, I think you start looking at some of the industrial metals and also at some of the food-based commodities.
I think that's a good place to wrap this space up. I know the food-based part of that Jake likes. Everybody here again, please make sure you follow Arlan Suderman. I have another space in about 6 minutes, so stay tuned for that. Thank you, Arlan. We'll definitely try and do this again with you.
All right. Thank you. I enjoyed doing it.